Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hi, everybody. Welcome back to the DIY Wealth Canada podcast by do-it-yourself investors for do-it-yourself investors. Today, we are welcoming another guest on the show. This is Anthony, the Newcomer Investor. You probably all know him from Twitter. If you don't, you should find him immediately because he's a good guy, a good follow, and a really good investor. We're just happy to have him on the show today. And, we're really looking forward to having a chat with him about his portfolio, maybe some other stuff as well. Anthony, welcome.
Thank you so much for having me. I'm so happy to be here. So excited to chat once again. Thank you.
Yes, that's right. Anthony, I was on his podcast maybe, a couple of years ago now. We had a really long discussion about all sorts of stuff. We won't go quite as long this time, but, really looking forward to talking to you. So first, let me ask you, how did you get started investing and kind of what sort of lit the investing fire underneath you?
Yeah, great question. So I was in my last year of university. I was 21 years old and just starting to think about life. I already had a job at the time, at the same time, right? But as I was starting to think about, entering my career officially and starting to be more of an adult, if you could say that, I was just really anxious. I live in Toronto, and as I'm sure everyone listening knows, the housing prices are very expensive over here. And so, people think quite early about money and, how is our future going to work out? So, around that time, I thought, okay, I know that investing is a thing. I should start looking into it. And I just, started looking at Warren Buffett and some YouTube videos about investing, learned about the S&P 500, ETFs, and I kind of got started from there. So I started with ETFs. And over time, I started actually getting really excited about the game of investing. So even forgetting about, making money or stocks and whatnot, but just actually analyzing a business, I realized that I'm really, really passionate about that. So I slowly started getting into stock picking as well. And yeah, it's been 7 years now. Super excited. I love the game. Never withdrawn any money and I have no plan to. So I'm a long-term investor. That's the plan. And that's kind of how I got into the game.
Yeah, very cool. I think that's most how we got into investing, most of us, right? Just getting interested in money and then start looking at the investing side. So you're pretty open on Twitter or X in terms of your portfolio update and such. And I think it's great that you've been pretty open. The openness is always welcome in this community, right? And you, just like me and Nelson, hold quite a bit of individual stocks, and then you also utilize index ETFs. So I see you hold XTQT. So kind of walk us through your evolution and investing journey, like why a combination of individual stocks and ETF.
Yeah, 1000%. So I'd say, and that reflects a lot in my name. So I call myself Newcomer Investor because obviously at the beginning I was a newcomer, right? And now I'm no longer a newcomer, but I am still learning, right? I look at investing as the sort of thing that, you got to stay humble. You're always learning. And I know both of you have been investing much longer than I am, but I'm sure that you still feel like you're learning every day, right? So I'm trying to embody that sort of philosophy and always never getting comfortable, always doing the same strategy and always trying to learn more and see if I can adjust over time. So like I said at the beginning, I did start with the S&P 500. I had that one. I had a Canadian ETF as well. And then as I slowly got a little more confident, as I started understanding, all the accounting and really starting to, analyze businesses, I thought, okay, there's room for me to make a few select investments. Now, in terms of how, things have evolved, I will say that at the beginning, I was probably more focused on dividends. So, I had a lot of dividend stocks because I perceived them to be more safe. And, on average, I'd say dividend growth stocks tend to be a little safer than, speculative small caps for sure. But over time, I started looking at it a bit more into total return, meaning that I still have a lot of dividend stocks primarily, but I also have, a few stocks that don't pay a dividend, but which I think, have potential here and there. And I do actually now, I quite like stocks that keep most of their earnings, such as Brookfield Corporation, which maybe we'll talk about a bit more later. It's my largest holding, it's my favorite. And I love these sorts of conglomerates. So companies that like I said, they retain most of their earnings so that they can reinvest them at high returns over time, over long periods of time. I think that's kind of the sweet spot for me, especially considering that, like I said, I'm a long-term investor and I'm looking at holding these companies for very, very long time. So Brookfield was actually one of my first individual stocks that I bought, and very, very satisfied with this one. And I'm hoping to keep buying more companies like this over time.
Awesome. Since you brought up Brookfield, that was going to be one of my questions. So walk us through why you like Brookfield Corporation so much. Like, I see in your portfolio, we're recording this in February. I see you have posted your portfolio update in mid-February. So you own 14.3% Brookfield Corporation, and you own about 2.1% of Brookfield Asset Management. We own both of these stocks in our investing portfolio. I think Nelson, you own BAM. I don't know if you own Brookfield Corporation, but yeah, Anthony, walk us through why you like Brookfield Corporation so much. Like, why the preference over, Brookfield Corporation over asset management? Just kind of the logic, because they're very close, and it's very confusing sometimes for some investors.
So confusing. Even I'm still confused. No, I'm kidding. I'm not. But yes, great question. So actually, I bought Brookfield before it split, between the corporation and the asset manager. So at the time, ticker was BAM.A, and it was called Brookfield Asset Management, and it was actually the corporation and the asset manager. So now I own a little bit of the asset manager because it's the spin-off that, I just got it in my account, but I own both. But of course, since the split, I have only been buying Brookfield Corp, and I haven't bought the asset manager. And the main reason really is, again, for those who don't know Brookfield, it's some sort of giant conglomerate that basically owns all sorts of businesses, the crown jewel being the asset manager, which is, private equity type asset management business. So, great business model where they take money from institutions, then they invest it into big funds, and those funds earn a recurring fee, right? Like a management fee. And then they also earn what we call carried interest, which is the profit that you make if your fund is successful, right? So Brookfield Corporation owns Brookfield Asset Management. So they get all the dividends from the asset manager, but then they also own these permanent capital vehicles, Brookfield Renewable, Brookfield Infrastructure, Brookfield Business Partners. And these are essentially the vehicles through which Brookfield Corporation invests its own cash into funds that the asset manager manages. So that's kind of a mouthful. It's a lot that's happening. But essentially, the corporation, like I said, it's a big holding company. They control the entire Brookfield empire, and they're built in a way that they will, survive very, very resilient. They keep most of the cash flow, and that lets them invest in assets when they're in distress. Now, in terms of why did I like it from the very beginning, I was really, really surprised at how great management is. So actually, I think my first foray into the Brookfield world, I'd actually always known of them since I moved to Canada, because how could you not, right? Because they own so many assets. There's even a huge, office area called Brookfield Place over here in Toronto. So they're everywhere. But my first foray into the Brookfield world, there was this video, which I highly encourage everybody to watch. It's from 2019. It's Bruce Flatt, who was the CEO of Brookfield Corporation. He presented at Google about, the whole Brookfield world. And I just thought, wow, these guys have a really, really special sort of vision. They are so long-term oriented, kind of like, Berkshire Hathaway, Warren Buffett style, right? And I thought, this is exactly the sort of business that I want to own, because I want to, I'm young. I was young at the time, and I'm still relatively young. And I thought, okay, this is a great type of company to have where I can trust management to make decisions, not just for the next quarter or the next 2 quarters, but rather for the next 10 to 20 years, right? And, 7 years later, that's exactly what's been happening. Very, very great long-term focus. The management team, I will say, between them and some other insiders, the board of directors, etc., they own about 20% of the business. So we have very, very high alignment with insiders as well, which I like. And all of those things combined make it a super powerful business, which I expect will continue to compound for long periods of time. And that's exactly the sort of business that I like and want to keep. And then I'd also say, the reason that it's such a big percentage of my portfolio too is that it has gone up a lot. Like I bought it in a few tranches. So the first one was in 2019. The second was in 2020 during the start of the pandemic. And the third was in 2023 when a lot of people were freaking out over real estate. And Brookfield has a big exposure to real estate. So the stock fell quite a lot. That's when I bought really significant amounts. And now it's up over 100% since then. So it's gone up a lot because of that too, because of the gains.
I think it's a great kind of seg into my next question, because Bob asked what part of Brookfield I own. I own the asset manager. There are two reasons why I bought the asset manager. One, I like the combination of the dividend yield and the dividend growth. And two, I like that it's sort of this asset light kind of asset where it can grow for a long time, and it doesn't really need a lot of capital poured into that business for it to grow. But getting back to Brookfield, which BN is, I would not fault anyone for owning that over BAM. The long-term returns on both, of course, back when they were one company, is excellent. So by all means. But I wanted to ask you, Anthony, I know one of the sort of the bull thesis on BN is that you get all these assets that you mentioned. So the infrastructure assets, the renewable energy assets, and the real estate assets, which of course they privatized back in 2022, I think it was. Now, there's this discount between sort of what these assets are worth and then what they're worth inside of BN. Did any of that kind of factor into your decision where you're like, hey, I'm buying sort of kind of $1 for 60 cents, or was it all sort of the kind of, the quality of management, and the quality of assets and so on?
Yeah, frankly, it's both. I mean, at the time, I mean, each time I did buy some of BN, I thought, okay, it seems like it's at quite a discount, right? When you look at all these assets that they own, so I thought that's probably a good time to buy. But yeah, honestly, though, it's mostly the management. I mean, like I said, BN is where all the managers actually own the business, right? They also own some of BAM, but it's mostly at the BN level. And for me, it's more just a way to invest alongside those guys who are professionals. I'll also add, I personally know a couple of people who work there. I went to business school at University of Toronto, so a lot of people want to work for Brookfield, right? And the two people that I know who work there are literally they're both the smartest and also the most ethical and hardworking, all at the same time, right? Who work there. So when I look at that, I think, okay, I get to kind of benefit from the expertise of all of these guys, and I don't even have to do any work. That's kind of how I look at Brookfield and some of my other investments too, right? If that makes sense.
Let me ask you one more question on Brookfield, and I'm going to venture into a little bit of conspiracy theory land here.
Oh, here we go.
Yeah, that's right.
Yes.
So the criticism I see all the time when it comes to Brookfield is the Mark Carney connection. Of course, for the people who aren't aware, Mark Carney was part of the board for a short period of time, kind of in between his, former job and now his current job. And everybody thinks that because of this connection between the Prime Minister of Canada and Brookfield, that perhaps Brookfield has some unfair advantages when it comes to, maybe purchasing assets or, getting asset sales sort of kind of pushed through the various competition things. Do you care about that at all?
No,
is this just
don't.
a conspiracy theory nonsense?
So here's what I'll say. And you said everybody thinks. I will say, I think it's everybody on Twitter, but probably not everybody thinks that there's a conspiracy. No, I think it does a big disservice to Brookfield and to Mark Carney to think that that their connection is going to have some sort of effect on everything else. Brookfield has thrived for decades before Mark Carney got into the picture. I got to remind everybody, right? He joined the board of Brookfield Asset Management, I believe in 2020 or 2021, right? I was invested in Brookfield before Mark Carney was part of this whole thing. I already loved Brookfield before, and I loved it while he was there, and I love it even after he's there, right? So no, I don't think it's going to have much of an effect, if any. I'll also add, for anyone who is curious about this, this is all public information. People can look into all the steps that they have to do in terms of the ethics commissioner screenings and that whole process to make sure that he is not part of any decisions related to them. There is a very, very big process for that. And again, like I said, it's all public, right? So no, I'm not concerned at all about it. I think it's, even if Mark Carney never existed, I think it would have been a great company and I would have owned it. And, even though he has worked there, I'm also still happy to own it.
Yeah, it makes a lot of sense. So Anthony, can you talk about how you pick out the individual stocks that you're interested in, and then what makes you decide to invest in them, right? So, I mean, when it comes to individual stocks, there's so many of them. How do you? What's your screening process? What's your selection process, and ultimately, what makes you decide to invest in one, especially something like you don't already own in your portfolio? right? Like it's easy for you to say, yeah, you already own Brookfield Corporation or BAM, therefore you're adding more to it. Where even I see your portfolio, you have CNR, etc. But what about a new position? How do you screen stocks and then do your research? Can you discuss about that?
Epic question. So I have a bit of a contrarian streak, which hasn't always worked very well, but it has worked quite well sometimes. I'm happy to say that all my top investments, they have been contrarian picks and they've done very well, which is why they're my top investments. But usually what I like to do, I have maybe 100 companies that I hold in extremely high regards that I think, oh man, these are great companies and I would love to own them one day. And I just kind of monitor them over time. And, if I see that they fall into some sort of disarray, I like to look into what really happened, right? I like to analyze, is it because they made a mistake? Is it because of competition or something like that? Or is it because they're unlucky and there's some sort of market disconnect or, market environment that makes it that, the baby's thrown out of the bathwater sort of situation, right? And that's usually when I strike. So one great example of that was a company called Franco Nevada. For those who don't know, it's what we call the gold streaming company. So essentially they just buy pieces of ownership of gold mines all across the world. They have around 400 plus assets. It's not just gold, it's also precious metals and even a bit of gas. And anyway, they had one asset. It was in Panama. It's actually, I believe it's the biggest copper mine in the entire world. It was a big asset for them. And, the Panamanian government, they had some issues. There was some protests and then they just shut down the mine. And so the stock fell some crazy amount. I forget how much, but it was quite a lot. And so, the market hated that company. And I thought, well, they still have 400 plus other assets that are still pretty good. So I started a position. And now, again, we're more than 100% up since then. Obviously, the company has I like to call it an almost invincible business model. They have no debt. They have cash flow coming from every direction, right? And now it's looking like this mine is going to be reopened. And it was only a year and a half ago, right? So again, it's this combination of being a bit of a contrarian and also having a long-term focus. I will say that for everybody, investing is different, right? And for me, I am happy and lucky to not be a hedge fund. So I don't have clients coming to me every day asking, why is your stock down and whatnot. I genuinely don't care if my stocks are down. I just like to buy a company when it looks like it's undervalued because of some, unrelated reason. And then I can hold on to it for as long as I need until it comes back, right? So anyway, Franco Nevada was a great example of that. And that's sort of what I try to do with all my new investments in general.
Anthony, I love that philosophy, probably because I do largely the same thing. I'm very much interested in looking for companies that are, like you said, baby with the bathwater, kind of unfairly beaten up. I think it's a wonderful kind of hunting ground for new investments. And I was the same as you. I bought Franco Nevada probably around the same time.
Yes.
As you bought it.
Such a great buy.
It was a fantastic opportunity, and I loved it for years. Like you said, it's a really good business. And then I saw that it went down, and I researched it, and it was like, oh, this isn't so bad at all. I thought it was a good opportunity, and yeah, we probably have right around the same cost base on that one. So
yes.
that was really good.
Come on, for people who don't know, I bought this. It was around 147 Canadian dollars. Is when I made my first buy. Now we're at 356. The business is the same. The fundamentals haven't changed. They were always great. It's just the market got a little scared, and now the market's more happy about it. And also, the price of gold did go up quite a bit. But even if the price hadn't gone up, it's still a great company, right? So yeah, that was an amazing opportunity, and they don't come by very often, right? So I like to say at this point, I'm probably buying one new company or two every year or so. That's the sort of cadence I'm looking at. I'm not. I think that's another difference between when I started versus now. When I started, I was a lot more frantic. And I feel like most new investors, that's how it works, right? It's you see opportunities every day and you're buying $10 worth of companies at once, which doesn't make a lot of sense. But now I'm happy to wait for a year and do nothing and then make one really large buy for 1 year. That's kind of how I'm looking at it now.
Let me pivot a little bit and ask you about the role of these two ETFs you have in your portfolio. So combined between XCQT and VFV, you're at about kind of 22%.
That's right.
Are they are they a hedge against your stock picking skills?
Yes.
Or are they more I can't find anything to buy, so maybe I'll just I have some money to invest and I'll throw it into those.
Yeah.
Maybe talk a little more about that.
Amazing question. It's actually both. So I'd say for VFV specifically, that's the S&P 500, that's really what I call a legacy pick. So this was my first ever buy, and I just left it there. So I bought it again. First buy, 63 Canadian dollars, I remember. And now we're at 160 something, I think, or 170, something like that. So that one I just thought, even right now, the US, they're having a bit of a mental breakdown. Like, I don't know what's happening over there, but it's still a great country, overall. They still have great companies and businesses. So I still want to own a piece of that. And also, I think it's nice to have some tech exposure because I'm very low on tech. And with the S&P, you get all of them. So I don't have to really think about who's the best between Google or Microsoft and everything, right? Everyone right now is anxious around, should I buy Microsoft or Facebook, right? But I don't care. I just own all of them with the S&P, and I just leave that alone. So that's a legacy holding. And then when it comes to the XEQT, it is exactly what you said. I like to put money there when I just don't know what to do. I get dividends all the time rolling in, right? And so I like to just buy that ETF with my dividends. And then if I need a lot of cash for something, I have my own cash reserves anyway, but I could also sell a bit of XEQT to buy, one opportunity. That's possible, though I haven't really done that at this stage. And also another reason, I do believe that as much as I love Canada, and North America in general, right? I think there are a few nice opportunities in Europe and Asia and so on. And XEQT is really kind of my main vehicle to get there. So that's another reason.
Yeah, I love that. Like, utilizing index ETFs to increase your exposure, diversification, that makes a lot of sense. And that's exactly why we own the likes of XAW, which is the ex-Canada International Index, and then QQQM, which gives an exposure to the tech sector, right? The NASDAQ 100. And yeah, you're right, Anthony, like Microsoft is looking very, very enticing. I'm certainly looking at Microsoft, but at the same time, we're like, we already own that through QQQM. So does it make sense to add more, right? So that's always an internal debate. And sometimes you just have to go with the index and rather than only another individual stock. So I have kind of two questions for you. They're kind of related and somewhat not. So for you, since you own a mix of individual stocks and index ETFs, in terms of individual stock, do you have an ideal number of holdings for that? And then the second question would be, when do you consider selling something you own? Like, what's your decision-making process when it comes to selling? Because that's selling
a hard one. Yes.
Decision for many investors. So I wanted to talk about that. So you could answer the first question first, and then go on the second one.
Absolutely. So I've struggled a lot with both of those questions. At first, when I started, like I said, first I had ETFs, and then I got so excited about the world of business and analyzing companies. I had up to 50 stocks, and then I was like, oh man, this is really hard because I really love this game of investing. So I actually want to listen to the earnings calls of every company that I own, right? So I'm like tuning into the calls. I listen to everything. I take notes in my notebook. That's how much I love this, right? So when I had 50 companies, I realized, man, this is really difficult. It's hard to be really knowledgeable in 50 companies, right? I also like to talk to employees of those businesses, right? That's how much I love this. So I kind of started cutting down because I realized I can't do this anymore. I'm at around 20 now. I think I'm exactly at 20 holdings, actually. Including ETFs, so 18. And I like that sort of number. So I'm trying to keep it around there. I'm thinking maybe up to 25, but probably nothing more than that because otherwise I don't have the bandwidth or the brain power for that. And then in terms of selling, I am struggling with this every day, honestly. Part of me wants to own businesses forever. And for a company like Brookfield, it's so easy because it trades at a discount, right? So I don't have a reason to sell. But when I look at a company like, let's say, Franco Nevada, that kind of got a little, overexcited maybe, right? I did trim like a little bit. And I do ask myself sometimes, how much should I hold on to it or whatever, right? So I think that's more of a problem for companies that are overvalued. And at that point in time, it would be hard. Well, I guess one example I have for you is a speculative holding. So I only have two that are small caps that I bought. That was very early in my journey. And I actually said, I'm intentional about this. I want to have a little bit of small cap exposure. And those are companies that I'm fully prepared for them to go to zero because, maybe that they won't work out, but maybe they will. And if they do, I'll make a lot of money, right? So one of them is called Abex Technologies. It's currently my third largest holding. It's ballooned up to 10% of my portfolio. And this is exactly the sort of company where every day I ask myself, should I sell? I don't know, because it's certainly overvalued by the traditional metrics of, how much money do they bring in. But it does, they're building something quite interesting that could be very valuable too. So I don't know, right? So that's a company where I'm struggling every day, wondering, should I sell? But for everything else, I don't consider any of my businesses particularly overvalued. So other than Franco Nevada, so I'm happy to hold on to them. And then I'll probably worry more about selling once they become overvalued. Sorry, that was a long answer.
No, that's
no problem. So just follow up question. You talked about overvalue and such quite a bit just earlier. So, one of the things that drives me nuts is when people start talking about how a stock is very expensive, and when I ask them for more detail, they're like, "Oh, a stock is over $100."
Oh no, no, I don't mean it like that.
I totally get what you mean. You don't mean by that. So, kind of talk me about how do you determine a stock is overvalued? Because there's so many different definitions, and
yes.
I absolutely do not like when people start talking about stock price as the sole indication of whether a stock is overvalued, because that has absolutely no indication of whether a stock is overvalued or not. So how do you determine that from your side?
Yes, no, thank you for pointing that out. So I'm on board with you. When I say overvalued, I absolutely don't mean the price of the stock. I'm on board with you on that. I look at, so first, when I look at a business, I like to look at what are the metrics that people typically analyze this business by, right? So for many companies, it's usually, price to earnings sort of thing, but sometimes it will be slightly different, right? So first, I look at what's the main metric or KPI, and then I look at, okay, what's the historical valuation that this business has traded at? Let's say, over the last 10 years, what's the average valuation? What's the median? What's the high and what's the low? And then based on what those numbers are, then, I may consider a stock overvalued or undervalued. So for one example, let's say, you take a bank, for banks, we like to look at PE and we like to look at price to book, right? For Brookfield, we like to look at, price to distributable earnings. Now, some of the Brookfield bears will say distributable earnings is a fake metric. I don't have time for that, but whatever. And so, those are the sort of metrics I look at. And then if we're falling really under, let's say, the average valuation, then I think, okay, that might be worth looking at. And that is when I do the thing that I mentioned earlier, when I say, okay, what's the reason that it's trading at that? Is it because management is clueless and it's going all over the place? Or is it because of some unlucky moment like the Franco mine closure or something like that? And then if that's the point, then I say, okay, that's probably a good time to consider buying. And then I'll usually start with a little buy, and then I'll kind of, add more over time.
Anthony, I love those simple metrics because I think that finance people in generally are, they're pretty smart. A lot of them research these companies in a lot of detail. And I feel like in a world of social media or whatever, Substacks and newsletters like my newsletter, there's kind of this sort of competition to who can come up with the most elaborate kind of bull thesis. Like it's almost like this, if you have some obscure piece of knowledge about a company, you somehow have come out ahead. When in reality, it's like the same stuff that everybody looks at that ends up driving the business. Like it's the key drivers. The key drivers are usually like, simple stuff, revenue growth, earnings, et cetera. That's it. These simple metrics, the Galaxy Brain people will tell you that they don't work and you have to look further. And by all means, you have to look further. I'm not saying you just blindly buy a stock that's trading at a 10-year low, PE or whatever. But just the simple metrics combined with some research and combined with a little bit of contrarian conviction, they really do work effectively. They're just better than what most people think. There's not a question there. I just wanted to chime in with that.
No, I agree. It doesn't have to be that complicated. People want to complicate stuff all the time to appear smart. And that's very nice. I respect people's intelligence. But, generally, like you said, I think it's limited to a very, limited range of KPIs that really matter. And then it's every investor's own, psychology, right? It's like, how strong are we to hold on to something when it's scary? And are we able to take advantage of moments? I mean, you all remember, right, when COVID started, and that was a real moment of uncertainty when I remember my portfolio dropping like 10% per day for a whole week. And I was kind of freaking out. I was like, oh my God, this is scary. But we were all strong enough, the three of us at least, and many others in the community, we were strong enough to keep buying. And actually, those were some of the biggest buys I've ever made were around that time, because we knew that, yeah, some of those businesses will probably still be around after the pandemic. And lo and behold, they're still there. And most of them are at all-time highs now. So, yeah.
Yeah, you brought up a really good topic in terms of taking advantage of the market downturn. And, as long as you know these companies are around and they'll do fine, it's worth taking advantage, back up the truck per se, right? That's certainly something I kind of regret during the financial crisis, because, if you look at the Canadian banks, they were down significantly.
Oh, yeah.
And I remember an old manager of mine was like, oh, it's a good time to buy Canadian banks. I was like, what the heck are you talking about back then? So, lesson learned, and COVID definitely brought in another great buying opportunity, and we bought Canadian banks. So we were buying a lot of stuff left, right, and center, and that pay out. But yeah, it's definitely difficult when your portfolio is down on paper, at least significantly over a short period of time. Since you brought it up, what's your recommendation to investors that worry about their day-to-day portfolio changes, or even month-to-month? Like, what's the best advice you could give to somebody who just generally like to look at their portfolio value kind of on a daily basis or regularly, and eventually lose sleep because they're either losing too much money or gaining a lot of money, and they want to sell and capture the gains? Like, what's your number one advice?
Good question. So first, I would say on the record, I do not give financial advice. So never take advice from me. But I would say that if I were to give advice, I think people need to try not to overthink this too much. Firstly, if people feel that they can't handle volatility, then ETFs are your best friend, right? So XEQT, it has 9,000 companies in them. If that ETF goes to zero, it means that the human race has been destroyed. And so you probably won't worry about your portfolio. So number one is ETFs are great. Secondly, if you can handle volatility, then I would say, just try, don't even have the apps on your phone. So make a buy maybe once a month or something, or once a quarter, and then don't think about it. So I'll give you one example. I don't know if I'm allowed to say this, but I'll say it. My sister-in-law, she's a little younger than me. She was in 2022. She opened her account and she was like, what should I do? And I said, here's a basket of a few companies that I think are undervalued right now. And she purchased it, and she literally looks at her portfolio once a year. And now they're all up tremendous. I mean, I made her buy, I think, EQ Bank at like $40-something or $50, right? And it's up a lot since then. And she literally never looks at it and doesn't care. And that's how most people should look at their investments, I think. If you look at your account 5 times per day, then you're all going to be stressed about price. But if you don't care, then it doesn't matter. Just let it compound. That's my advice, if I were to give advice, which I don't.
There's an old story about the investors at Fidelity who forgot that their accounts existed, outperformed their peers significantly because they just left it alone. And I think that, this is probably a good time to remind everybody that nothing that's said on this podcast is financial advice. But I would say that my advice would be, like, if you're freaking out over the price of your assets when they have gone down, when they've gone up, whatever, just do like Anthony's sister-in-law and just forget about the whole thing. Live your life and don't worry about investing so much. Like, Mr. Market is here to serve you rather than the other way around. Like, don't freak out. But anyway, I digress, because I wanted to ask Anthony about some of his newer positions. And I know one that you've been buying is Thomson Reuters.
Yeah.
Which is, now when people hear the word Reuters, they think about the
news.
The news wire service where here's a story from Reuters, but these guys are much, much more than that. So Anthony, could you talk a little bit about Thomson Reuters and kind of what attracted you to that stock?
Yeah, so that's one of my newest holdings, and it exactly fits that category that I was saying of a business I've known literally for like 10 years, but never purchased it because it was always trading at eye-watering valuations, and I thought, what the hell? But they've suffered a lot, like really a lot over the last couple of months, and I thought, okay, it might be interesting. So I began a starter position, and I've been averaging down, and I think I will continue throughout the year. But to give a very quick explainer, Thomson Reuters, they're essentially an infotech company. So they sell software or information tools to all sorts of corporate businesses. So it's a B2B company. And they sell them those so that they're able to actually do their work. So the number one segment, which is the one I'm most fascinated by, is the legal profession. So they sell, legal software to them, including a platform called Westlaw, which is a legal research platform, and then some AI sort of tools that helps lawyers draft contracts and things like that. And so right now, as you all know, right, there's a lot of progress in the AI world. There's this company called Anthropic that did some sort of legal software AI tool as well. And so all those legal businesses, they literally crashed 20% that day. So now Thomson trades at a forward price to earnings ratio of, I believe, in the low 20s, when historically it's been like the mid 30s and even high 30s. So it's quite a discount. Now, if people believe that their services are sticky enough to survive, which I am of that opinion, then it may present a good opportunity. One thing I'd like to say, because people don't understand how some of this stuff works, right? When you're in a white collar job, in an office, and you're dealing with these sorts of, licenses of these softwares that you're buying, right? You're generally not on a day-to-day gonna go and switch to some random app that a 20-year-old just did with ChatGPT. Usually you're gonna stick with the, tried and tested, proven method that has worked for 20 years, that will still work for 20 years. Kind of like a Microsoft, no one likes Outlook. I don't like Outlook very much, but we all have Outlook and we will all continue to have Outlook. And so Thomson Reuters has, you could say, the outlooks of the legal profession in North America, right? So I'm pretty certain that they're still going to be there 5 years from now, but they'll be making even more money. And, now is probably a good time for anyone who has been looking at it or considering. It's probably a decent time to start. I'd also say that their revenue growth, organic growth, has actually been accelerating. So, a lot of people are saying, oh, AI is going to slow them down, but AI has actually helped them accelerate in the last 2 years. And they've guided for even more acceleration for 2026. And they always meet their guidance, which I really like. So, yeah. It's an interesting one.
I was going to ask you, I think you shared kind of a similar story on Twitter, X, whatever you want to call it. And I wanted to share that I have a friend of a friend who is a lawyer. And so I was chatting to the friend, and he was telling me that he chatted with his buddy about all of this AI stuff. And the friend who was a lawyer said something to the effect of, if I'm working on legal cases with potentially tens of millions of dollars at stake, I am not switching to some like bullshit made up app that someone, like you said, made on ChatGPT.
Exactly.
I'm going for the best that I know that works, that has worked for me like 100 times before. And he's like, it's worth every penny, and every lawyer in the world will tell you like just how valuable this is.
Exactly. So one of my best friends, she's also a lawyer, one of the top law firms in Canada. And I talked to her about this too. I was like, do you guys use these tools? And she said, yeah. And I was like, would you consider just making your own or getting it from some random person? She was like, no way, because the cost of the law firm to buy these licenses, it's really minimal, right? It's like 1 or 2 billable hours of a partner at a law firm. So it costs them nothing, but it brings them a lot of value. And you have to consider that every law firm competes with every other law firm. So if other law firms are using the best, why would you not use the best too, right? Why would you switch to something else? So yeah, there's that piece. And then there's just the internal bureaucracy and internal politics of switching software. It's so hard to switch anything else. You got you got different generations of workers usually at work, right? You got people who never want to switch anything. It's hard to convince to get some sort of corporate change in terms of what software you use. So all of those things put together, to me, suggest that it's a very sticky business that's unlikely to go away anywhere anytime soon. And then another thing too, I mean, I've had people point out again, say, oh, why are you buying Thomson Reuters? Because, the news media industry is dying. And I'm like, yeah, okay, but Reuters is 10% of their revenues. It's almost irrelevant compared to the tools that they're selling, in the legal and tax audit industry, right? So people, like you mentioned at the start, they're focused on the Reuters name and the global print and all of that. But that is a small piece of the business, and it's kind of, no one cares about that. I don't care about it personally.
Yeah, having worked in high tech, I tell you, changing software and having worked with lawyers in our company, like changing software is not an easy decision. And like you said, like some of these software, relatively speaking, for the amount of dollars they bill to clients or, they charge, it's a drop in a really big bucket. So why would they change it when they know it works, right? So that makes a lot of sense for sure.
Yeah, exactly. And then, sorry, I'll just add that one last little piece too. People don't realize Thomson Reuters, they have because people say, oh, well, what's the moat of this stuff? Because anyone else can do some legal softwares, right? Well, not exactly, because they have a lot of history to begin with, right? They literally started it's something, what's it called? The West Key system. It's literally the system of how to classify legal files. They're the guys who started this in the 1800s or early 1900s. And they literally got, they worked with the American Bar Association and other groups to basically spread their system of legal taxonomy everywhere in North America. So that's literally, it started from the very beginning, and all of their tools are built up from that. When you go to law school, you literally learn how to use this system, right? And by the way, every law student has access to this system too, the software, because Thomson Reuters sells it to the law schools as well, right? So they have an unfair advantage in that way, in that everyone who goes to school already knows how to use this. It's kind of like, I like to talk about it as like Excel for a financial analyst, right? It's like everyone who wants to work in finance will start with Excel. Now imagine being an investment banker and now you got some random guy who wants to sell you another system to calculate stuff. Like, that's ridiculous, right? So that's how I encourage people to look at it for Thomson Reuters and their tools. It's the same.
So we're coming up to close to the time of our typical podcast length, but I wanted to ask you about something that you brought up, in particular AI. How do you see AI influence these stocks? Like we see a lot of these software companies that come down due to these scares that AI could just quickly create another software and replace Salesforce or Adobe or whatever. So there's concern about AI disrupting the industry. That's one. But then there's also thoughts about AI really boosting revenues for certain companies. What's your view on AI overall? Like, are you really looking forward to AI, or how would you change anything in your investing parameter evaluation because AI or not?
Great question. I'd say firstly, the majority of my holdings tend to be, I don't want to say AI proof because nothing is AI proof, or I don't know what is AI proof or not, but I would consider them to be mostly AI proof because they're more real asset based, right? So Brookfield, you know what I mean? An oil pipeline, good luck getting AI to vibe code an oil pipeline, right? Or Alimentation Couche-Tard, right? It's convenience stores. I mean, AI is not going to replace that. Or Franco Nevada, the precious metals, right? So I got a lot of those, or Canadian National Railway, right? So those companies, I'm really not concerned at all. I think if anything, the effect will probably be positive. Maybe it'll help them have better analytics, or I don't know, it'll be good. When it comes to software, my exposure is fairly low. And I would say that's where, people got to be careful. It's probably going to be mostly good for incumbents, is my opinion, because they have more money than everyone else. And they're also investing in AI, like the little startups that are getting all the attention. Thomson Reuters included is investing a lot in AI. But I'd also say a business, let's say like Thomson Reuters, it's going to help them because lawyers at the end of the day, like, what's the point of a lawyer, right? It's just to have someone kind of reassure you that everything's going to be great, right? So I think AI is actually going to free up their time to do more client relations, client services sort of stuff, rather than all the boring, drafting a contract and things like that, which AI will pick up. So I think for some businesses like Thomson Reuters, it's going to help them. And that's certainly the view of management. Again, like I said, because of their progress in AI this year, organic revenue growth has gone up because lots of people are buying their services, and they think it's going to continue to go up. And I'm of that view as well. So I'd say it's very dependent on the company itself. But for most large businesses, I think AI will be beneficial to them.
I've always loved the argument that AI is going to, some schmuck like me, I'm a schmuck, is going to be able to type a few lines into ChatGPT and fart around for a few hours and suddenly get a functioning piece of software. Like, how is a professional going to use something like that? And kind of the benefit that they'll get from that. Like, they're going to benefit from that way more than what I'm going to benefit from that. Because one, like you said, they have the resources to invest in AI. And two, like, I can barely work Google sometimes. Like Bob and I, we did one episode where my mic was all, buggered up, and like, I broke my mic and I don't know what the hell happened. So the point is like, the professionals are going to implement AI. It's at least my view. And then, they will get benefits from that. And I agree with your other assessment where it's like, AI is going to benefit a lot of old school companies, just like the spend on tech has benefited these companies kind of over time. And a perfect example is CN Rail, where it's like they've invested in technology to make their locomotives more efficient. Therefore, they go faster, they burn less fuel, and the company becomes more profitable. Well, the Thomson Reuters example of that, with them investing in AI, I believe is just going to just accelerate that company's growth as well.
Exactly. It's a good thing. For investors should be excited about this. And so I'm doubly excited when I see great companies that fall 20% in one single day because some random startup did an AI product. Like, that's great. That's why I've been buying Thomson. And I expect Thomson is probably going to be my biggest buy throughout the year if it stays around the levels that it's at right now. And like I said, right, I'm trying to buy one per year or so. So I think this is going to be the one. That's my feeling.
My train of thought is, let's take Adobe, for example, and how people are worried about AI replacing Adobe's software. I'm a photographer, so Lightroom, Photoshop, or even like Adobe Reader. Like, I think it's overblown personally. If you look at Adobe software billing method, like they went away from, went away from the pay ones and only software to subscription based a number of years ago. And to be honest, that's the worst model for consumer because you're usually not paying every single month. And anyways, but that's a very, very profitable method for these software companies, right? So if you use Lightroom or Photoshop, you just pay and pay and pay. But even like if you look at the photography software, they're open source software, just like Lightroom, just like Photoshop, that's been available for years. Have they been able to overtake Adobe? No. Why? Because Adobe keeps coming out with new updates and improvements on their Lightroom and Photoshop. And with the subscription base, now they're offering, cloud storage for Lightroom and Photoshop subscribers. So for me, if I were to use AI to generate or create a Lightroom-like software or Photoshop-like software, would I be able to capture some revenue? Yeah, maybe. But would bulk or the majority of the Adobe subscribers switch over to my software? Probably not, because if they're so used to the cloud storage and the easiness of using that, I can't replicate that, right? I have to set up a huge data center to offer the same service. So
exactly.
I think it's way overblown in terms of this AI. Oh, AI could create software, and therefore all these software companies, just like Microsoft. Look at Office, right? Again, subscription based now. Sure, you could get a one-time payment in Office, but you don't get the cloud side. And for companies that nowadays use Google Office to collaborate, PowerPoint, spreadsheet, being able to save your file on the cloud and then share that seamlessly, and everybody could go in and edit at the same time. That's a major life time saver, improve efficiency tremendously. For an AI or somebody using AI to create a software like Excel or Word or PowerPoint and then selling that to the general public, you have to have that cloud-based service in the background as well. And that's very, very difficult to replicate. So again, I think that's really, really overblown at this point. Now, whether my train of thought or my thesis is true or not, we'll have to check back in, a couple of years from now.
Yeah, no, I agree. It may take time for the market to internalize and digest this sort of thing. I mean, I will say I was taken aback and by surprise at how much Thomson fell based on this AI thing. Like I always thought there's no way it's going to fall like 60% from highs, but it did, right? So, and then maybe it'll take a long time, but that's where it helps for us to just be ourselves and not big hedge funds. We don't have clients asking us every day, hey, when are your stocks going back up? I can wait 10 years for Thomson to come back. I don't think it'll take 10 years, but I can, and I can keep buying during that time period. So that's our biggest asset as retail people, right?
Exactly. Anthony, we have to wrap it up. We're running up on time here, but just what a great discussion. I know that for me, one of the big advantages of having this podcast is I can have an excuse to reach out to investors that I respect and I admire, like you, who we can have these kind of long form discussions about these stocks. And we have so much more to talk about. So will you come back for a subsequent episode at some point in the future?
Yes, 1000%. This was so much fun. You know, I really respect and admire you guys too. I learned so much from both of you. So it's an honor for me to be chatting with you, and I'm happy to chat again anytime.
Fantastic. And before we go, Anthony, can you tell the people where they can find you if they want to learn more?
Oh, yes, please. You can follow me on Twitter at Newcomer Invest.
Fantastic.
And I also have a podcast called Newcomer Investor. You can also check it out on all platforms.
That's right. I've been a guest on that. So, click on that one first and then go to the other ones.
Hell yeah. Thank you so much.
Yeah, thanks so much for coming on the show. It's been great.
Thank you. Really awesome time.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.